Hi, I'm Karen Lee, a certified financial planner and the owner of Karen Lee and Associates and a registered representative with LPL Financial. The question today is, how does one take money out of a life insurance policy? Well, first of all, we must be talking about a permanent life policy in order to even ask that question. Permanent life insurance has a buildup of what's known as cash value. It's actually excess premiums. And so your question is, how do I access that cash value of either a whole life or a universal life policy? There are three different ways. The first is a withdrawal, the second is a loan, and the third is to simply cancel or surrender the contract. We're going to go through each one individually. First, let's have a conversation about the taxation of life insurance cash value. Every time you put money into life insurance, and that is called your premium, the entire premiums create the tax basis of your contract. So the money that you've already deposited in terms of total premiums has already been taxed. The earnings, on the other hand, whether it's dividends from a whole life policy or interest from a universal life policy, those are growing tax deferred. Now let's go through individually each of those three ways I mentioned. The first is a withdrawal. When you go to take money out via a withdrawal of a permanent life insurance policy, the IRS treats it as what's called Fifo Accounting. Fifo means the first in is the first out. So your premiums, the total amount of your deposit, can come out first after tax. So via a withdrawal from a life insurance policy, you may withdraw up to the total amount of premiums you've put in, free of tax. The only thing to be careful of there is some companies charge excess withdrawal fees, so you've got to look at your contract to see if there might be any penalties. The second thing we've discussed is taking a loan, borrowing against the cash value. At that point, you may borrow even all the premiums plus the earnings on your contract, and the insurance company does not notify the IRS that you've taken a withdrawal. Therefore, there is no current income tax due on that loan. But again, remember, check with your insurance company and make sure, if you're trying to avoid paying taxes on the earnings that you have loaned out, that you do not let your policy lapse. If your policy lapses while there is an outstanding loan, at that point the insurance company does notify the IRS that a distribution has occurred, and any earnings that had never been taxed would currently be taxable. Again, remember, if you borrow money from your policy, it likely reduces your death benefit as well. And last but not least, you can always just cancel your life insurance contract. Now remember, of course, immediately you will no longer have the death benefit of your life insurance. If you surrender your policy and you have more in the cash value than the amount you've deposited over the life of the contract, you are going to have a taxable event at the end of the year for the earnings that have never been taxed. This is typically called surrendering a contract, and again, very important, check with your insurance company before you surrender. Almost all permanent life insurance policies have surrender charges that last anywhere from 5 to 10 years to even 15 years since you took out the policy. So you want to make sure you're not paying any penalties if you choose to cancel your life insurance. I hope that answered your question on how to withdraw money from a life insurance policy. My name is Karen Lee. I'm a certified financial planner, the owner of Karen Lee and Associates, and a registered representative with LPL Financial.